in the New York session, we saw really commodity-related currencies gaining against the U.S. dollar, but we have seen incredible strength for the greenback. This GTV chart on the Bloomberg showing how emerging market currencies on the other side now at the lowest level since May 2020. What's the trajectory for the U.S. dollar given this haven demand?
Yeah, I mean, you're definitely right, Shery. I mean, the Omicron does throw a spanner in the works, but the dollar seems to be supported one way or another. Right now, if it's haven demand, then you get the dollar propped up just due to the safe haven demand. But if we get out of this and the risks from Omicron are assessed to be fairly contained, then we get back into the Fed policy divergence path, in which case we get the dollar strengthening as the Fed leads the way out in normalization, and sticky and elevated inflation that's inconveniently so means that real returns, even in the emerging world, is not going to be particularly attractive. So that would probably lead to the dollar retaining quite a bit of traction, at least into the first half of 2022, before we see a broadening and some policy catch-up.
Where does that leave the Japanese yen? Because, of course, we saw the policy divergence really pressuring the Japanese currency, but all of a sudden it's become a haven of choice during this turmoil.
That's a great question. So we were caught by Omicron. I mean, we were looking for the yen to get, appreciably, forgive the non-pun, appreciably weaker given the sustained policy divergence. But you're right. I mean, when it comes to haven demand, I think we will see a rather twitchy dollar yen, at least until some clarity around this may be derived.
Vish, you hear a somewhat uncertain Jay Powell in his prepared remarks to the Senate Banking Committee. Is there a sense that we should be paring back some of these tightening cycle expectations because of the uncertainty over this variant?
I think to some extent markets already did. I mean, the brutality of the moves in the yields as they plunged on Friday. Some of that ground has been made back up again, but we do see caution in pricing in the extent of adjustment to the policy right now. I think the two things we need to look out for are the steepening, or rather the flattening bias in the 530. That will give us a sense of how quickly the Fed may step up the pace of taper. For rate hikes, I think Jay Powell would want to retain a lot of flexibility around it, and I think he'll reinforce what he said at Jackson Hole, that the end of taper doesn't mechanically start rate hikes, but give and take, a mid-year 2022 rate hike is still on the cards, so long as this virus does not, or any variant risk for that matter, does not derail the plans, because inflation will probably be sticky until at least second half of 2022.
So what's the most opportunistic strategy then going into next year? Because if you take a look at the price action between Friday and now, it seems this concept of risk on or risk off isn't really playing out the way that we might expect.
No, you're right. I think markets would have some degree of insurance bets priced in. So I think that some degree of insurance will remain. As we just heard earlier, I mean, it's going to take at least 2 weeks to get any clarity on how much of a risk this virus is. Right now, we've only got anecdotal and very surface evidence. So the insurance bets will remain in place. It looks to me that any sell-off in the dollar because of a pushback to the Fed expectations is an opportunity to buy back the dollar, given it would get some haven demand or make background on the Fed policy divergence. Our big view that we are in a bit of a Kokomo policy space where Fed wants to get there fast and then take it slow, that remains intact, because the take it slow part is for insurance after that. But get there fast is to really anchor inflation expectations. And an irony here is that the virus risk could initially lift inflation rather than alleviate it.